Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Good morning and welcome to the Smart Investing Show. I'm Brent Wilsey, and thank you for joining us this morning. Been doing the Smart Investing Show here in San Diego on local radio for 28 years now. If you have investment questions or want a fundamental analysis of a stock you own or looking at buying, selling, or holding, give us a call at 866-577-2473. That's 866-577-2473. As always, for that unbiased, no strings attached, fundamental opinion about what you want to talk about. And Chase, good morning. How are you doing this morning?
Good morning. Doing good.
We got everything all kind of like backwards today and things a little bit different. Without Brendan here, gosh, we miss Brendan. I know he's got a vacation day, which he deserves as always, but everything. Oh, shit.
Oh, can't cuss there. Yeah, I know. It's gosh, it's just a mess this morning, but we're still here. We're still ready to do the show.
Yeah. No, my computer just came unplugged, and that's why.
Yeah.
So, all right. Well, we got a lot to talk about before we take the calls. Let's first of all, we got a workshop coming up at Ale Smith Brewery coming up on May 20th, 6 o'clock. And last time was very well. They had that great food there with a food truck there, and people bought beer and so forth. It was a great time.
Good atmosphere. A lot of fun.
Great atmosphere. A lot of fun. And we really give a lot of information about how we manage money for people, how we manage our own money. A lot of, I don't want to say secrets, but a lot of behind the scenes of how we do things and how I've been successful. I've been in the finance world now for over 40 years, and what I've learned doing that, and how we managed through the COVID last year, and what we see going forward, how we're going to manage things going forward. So it is a free workshop. What you can do is go to our website, smartinvesting2000.com. You can sign up there. Again, that's smartinvesting2000.com. You can call the office, 858-546-4306. That's 858-546-4306. Just listen for Brianna when you hear her number. I think she's number 5 on the phone tree.
I think so.
Just press number 5 and tell that you want to attend the workshop on May 20th, 6 o'clock. That's a Thursday at Ale Smith Brewery. All right, so a lot of things to talk about here before we take your calls. So let's start off, and this is something that kind of stood out to me because I'm not worried yet, but I'm always looking for signs of things that can change going forward. And one thing that I saw was the subprime car buyer is once again having trouble. Currently, 10.9% of the subprime car buyers are more than 60 days late on their payments. And this is kind of, I'm watching. I'm not worried like, oh, my gosh, things are going to collapse, but I want to bring this out for people.
Yeah, I mean, it hasn't been this high since 2005, which, of course, also included the Great Recession in 2009. And I'm kind of surprised by that the, late payments weren't higher in 2009. Yeah. It's kind of a shocker. But, with the shortage of new and used cars, perhaps the repossession rate of these cars could pick up quicker because you need to get more cars on the market. I mean, the used car market is just on fire right now.
I know.
I mean, the new car market is too, and then we have the chip shortages. I mean, there's just so much going on in the car market. And, I'm kind of surprised that the payments are late. I mean, what do people do with their stimulus checks, or their unemployment? There should be money going towards those car payments.
And what it could be is that there's just too much money coming in, and you don't realize how to handle it. And you kind of overextend yourself, like, oh, this is so great. I feel like I'm so rich, and I'll get a car, and I'll get this, I'll get that. Like, oops, my what is it? When your income exceeds your outflow, that is your downfall. And so if you have, we'll just say $4,000 coming in, but you've overextended yourself to $5,000 a month, yeah, you're getting more than before, but now you're in a situation to where you can't get out of it. And that's what I'm kind of hoping it is. It's just a few people, not the whole economy, but we'll watch this closely. And what could happen too, Chase, is that they could actually start repossessing these cars quicker because the demand for used cars is so high. So, like, sorry, you're 60 days late. We're going to take your car. So.
Yeah. I mean, it's, I don't know, kind of getting a little off topic here, but still on the same topic. You know, I was on Fox 5 this last Wednesday and was actually talking about emergency savings. And, you know, the anchor Raul there asked about at the end, well, do you think that COVID is going to make people kind of wake up and realize, oh, I need to take care of my finances? And I said, you know, I hope so. But this kind of shows me that people aren't waking up at some parts of their financial lives. Yep. And I said the thing that scares me is I think now that people think the government can just come save them. You know, oh, they're going to boost unemployment again. If I lose my job, it's fine. They'll boost unemployment. We'll get stimulus checks. Nobody knew what a stimulus check was 20 years ago. Yeah, it's just crazy. But, you know, this is kind of, again, nothing that it's going to take down the stock market. It's going to take down the economy. But I'd say there's some inklings there of concern.
Yeah. And the thing, too, that you kind of worry about that because you're right. Are people falling into this trap, which I hate to say, I don't want to get political here, but I think some people in higher powers want this to happen because they want to go the socialist route. Well, that's what happens if you make people dependent on you. They won't know how to go out and get a job, and they won't know how to make money, and therefore they are going to be waiting for the government, which puts you in this difficult situation. Obviously not good for the investing world down the road either. I mean, if people – I've never studied, have no clue how investing works in socialism. If it even does work, do they even have investing in a socialist country? I don't even know.
I don't think so because everything's owned by the government.
Yeah. So what a terrible change that would be. I mean –
I don't think we'll get there. I don't want to go down that dark path. But,
yeah. If you're on the government – return those checks. Do something. I mean, go to work. Yeah, and I say that jokingly, but it is true because you hear employers. There's so many help wanted sites out there that employers are saying we can't get people to come to work because they're getting paid more for staying home than they are coming to work, and that is a social economic problem maybe because in a way I get what people are doing, but we went to. So nice. Went to Applebee's for lunch with a client on Wednesday. So nice kind of get back to like, oh, we can do this again. But my client asked the waitress, like, now, why are you working? She goes, because I was so bored staying home. I wanted to come into work. So, and usually it gives you a better attitude because you're fulfilling something as opposed to staying home and just, I don't know, watching. Do they even watch soap operas anymore? I don't know. I think they play video games maybe now.
No, they're still soap operas.
They're still soap operas.
Well, it's not soap operas. It's reality TV.
There we go, reality. That's right. That's soap opera, reality TV. So it is something that, again, this could be the tip of the iceberg with the car loans. I'm hoping that it's going to change. But let's change gears here because I think every week for the last few weeks we have talked about Bitcoin, but I couldn't let this pass because I hate the Bitcoin hype, as I call it. Kansas City Chiefs tight end Sean Culkin says he will take all his money in Bitcoin. But when you read the details, I want to say something else, but I can't say it on radio. I'll just call it hype.
Smoke and mirrors.
Smoke and mirrors. Exactly. I like that one. That's much nicer than what I wanted to say.
Yeah.
Bull, you know.
Well, and it's funny, too, because, on draft day, Trevor Lawrence, who was the first overall pick, great football player, he said, I want to be paid in Bitcoin for my bonus.
Right.
But it's the same thing. He's not being paid in Bitcoin. He's actually being paid in dollars, paying taxes in dollars, and then he's converting it to Bitcoin. I mean, it's a big difference because, again, you break it down. Let me repeat that. When you read the details, you see they're being paid in dollars, not being paid in Bitcoin. Then they pay taxes on those U.S. dollars.
With U.S. dollars.
With U.S. dollars, and then he's converting it to Bitcoin. And then get this. If he sells Bitcoin to convert it back to dollars, he has to pay taxes again on dollars on the gain. It all comes back to the dollars. I just, it's crazy to me.
Yeah. And why is this done? Because there's people out there that want to promote Bitcoin. And I think this is also like a lot of people want to be the cool kids. I want to be part of the big party. And, I don't want to miss out on the sorority thing. I mean, that's what it is. And when you still ask people that are so hyped up about Bitcoin, well, what is it? They still can't explain it, and they don't get it. They just want to be it. And I've seen this happen many times before. I know last week, I forgot the name of the book now, but about the madness of crowds and so forth. This is what's going on. There's a select group of people that are pushing this up. And I just don't believe. And what happens? And again, Bitcoin could go to 100,000. I don't know. Nobody knows. And that's the crazy part. No one knows. But what happens if Bitcoin goes from 50,000 down to, I don't know, 30 or 35,000? Will the party be over? And then what happens? Yeah.
Yeah. I mean, the thing I just don't understand, you kind of brought it up, is when you ask people about it, it's like, well, is it a currency? Some people say, yeah. And the other people say, oh, no. Bitcoin should not be viewed as a currency. It's like digital gold. And then you ask another person, and it's a completely different ideology of it. And I mean, I was, had a Facebook conversation with a guy, and, good guy. But we were kind of going back and forth on it. And I said, I just don't understand it because, like, if, let's say you want to buy a Tesla with Bitcoin. Well, why would you do that? If you think Bitcoin is the future, it's going to $100,000, let's say. Why would you sell your Bitcoin to buy a Tesla? The Tesla is not going to appreciate by 100%. Not to mention, you also put yourself in a tax bind because now let's say you buy a Tesla for $50,000, you have to pay taxes on any of the gains that you had on that particular Bitcoin investment. I mean, why would you do that? That makes absolutely no sense to pay taxes and limit yourself on the compounding going forward. So my whole point here is I just don't see what value Bitcoin has, not from like obviously we know it has no earnings, but what does it provide to society?
Right. Right now, actually it takes from society because of how much it takes to actually develop a Bitcoin. The energy use, I guess, is extraordinary. But the other thing, too, and I did learn some this week, and I don't know if I can remember the name. Maybe you remember it. But Landry's restaurants are saying, oh, now they're going to take Bitcoin. And I put out the question, well, you're not going to pay $50,000 for a dinner, so how are you going to pay up for a $200 dinner? And the gentleman brought up something about there's a...
Like Shiroshi or something?
Shiroshi or something.
Yeah.
And he goes, it's like change. Like when you have a dollar, you have a dollar, you break it for like a quarter, and you take it, 10 cents and so forth. But I've never heard that before. That's the first time I ever heard that. But still, that worries me because here's now another unknown, a Shiroshi who was designed by some gentleman. And I say a gentleman, I don't know. Maybe he's not a gentleman. But it's just more things that are kind of out there. Like, well, what is that now?
Well, so then the other thing is, and I think we need to move on after this because we can talk about it for hours. But the other thing is, well, it's great because, the government's out of it. It's a peer-to-peer network, so you don't have to worry about government intervention. Well, the government keeps talking about concerns over regulation because of, the dark market and, ISIS and all these different things, to use it. So the government's like, we need to make sure that we're not doing this. So we need to regulate it. I was reading an article. The government's like, yeah, we found ways that we can kind of make some regulations for it to kind of intervene a little bit. So then now you lose that other positive of Bitcoin, and now what's the purpose of it?
You've got air. That's what you have. Yeah. So, and again, it could go to $100,000 because I've seen craziness happen before. It happens time over time again, where you get groups of people that just are into it. This group will buy things, they'll bid it up, and all of a sudden they wake up and somebody like, well, no, this is not worth anything, and all of a sudden people lose money. So it's
before the tulip bulb crisis.
Yeah,
tulip bulb more than a price of a house makes no sense.
Yeah, and you had the tech boom and bust. You had the Nifty 50. I mean, there's history lessons that tell you this, but people say, oh no, this is different this time. Like, all right, well, good luck there, and I just hope that you get out before. And that's the thing too. If you get out before the craziness ends, you'll be fine. Yeah. But if you ride it till the end, you'll be left in the street crying.
Yep.
So, all right, well, let's move on here. Talk about the average institutional equity fund because this does include mutual funds and ETFs. But the average institutional fund, equity fund, is only holding 4% of its portfolio in cash, and this is according to Bank of America. And for me, this has always been a signal to be cautious here because if you don't have much cash, well, you can't do much buying.
Yeah, I mean, they're, of course, less likely to buy and more likely to sell to raise cash. It's like if their positions hit targets, it's like, okay, now we need to raise a little bit more cash. So now you're creating more selling and less buying opportunity. And another concerning sign as well is households currently have the highest share of their assets in stocks in more than 50 years. Household equity holdings now make up 47% of the total assets, according to Citigroup.
Yeah, and this is just, again, science. And you're kind of happy to see it because more people are getting into equity investing. But my concern is, are they getting into the right part of equity investing? Because, well, they're just doing the hype and buying the GameStop and buying. And what actually happened to that? Because you don't hear much about what do they call it?
It kind of like hit at like 140, and then it's just been stuck in that range. Well, it actually dropped all the way to like, I think it dropped down to like back down to 40. Then it went up to like 140, 170. I mean, the high was 483, and it just seems like it's been at like 140 to 170 for a while, and there's just not much.
The high was over 500, so I mean, a lot of people have lost their shirts on it. But
no, it was 483 was the high.
Oh, okay, 43. Okay,
Yeah.
so 500.
Yeah.
Still, no, I would not be the guy that paid 43 and still holding it now. But the thing is, you don't hear much about that now. For a while, we're hearing about the Reddit crowd with GameStop, and there's a couple other stocks.
There's like Koss was another one, and for a little bit, remember like Tootsie Roll got involved in it.
Tootsie Roll got involved in it.
There's a few on there.
And and actually, this past week, I talked to a client, and he go, "Didn't that kind of happen with Hertz Rent-A-Car?" I said, "Well, this was before, but it's a similar thing with and I think it was a start because they filed bankruptcy, and the stock went down, I don't know, 2, and somebody like, oh wow, this is great, and all of a sudden they bid it up to I think it was like $6 or $7 a share.
Yeah,
and it was craziness. Actually, that happened to Eastman Kodak.
I was going to say that one too
as well. So this has happened, and there's people that are getting burnt on this because that's gambling. That's all it is. You're just hoping it goes higher.
When you have people that are like, oh, I don't care because I bought it at 4, it's like, well, good for you. But also that means you could have sold out at 483. So don't tell me you're all excited about it going from 43 to 173. I mean, that's a huge decline on your profits.
Yeah. And then many times too, people, I bought it, and it's like 0.1% of the total portfolio.
Yeah. And I did want to bring out another number. I made sure to kind of pull this in because talking about that 47% of the total assets for the household, I mean, if you actually look at the last time investors were this heavily invested, and that was in 1970, right, the S&P 500's annual return compounded over the next 10 years, it was below 5%.
Oh, wow.
Not good returns. And also, too, you look at another time and period, the tech boom, 1999. I'm sure you remember. People loved stocks. People loved stocks back in 1999. The tech stocks, it's great. Well, over that decade from 1999 to 2009, the S&P 500 had negative returns. Yeah. So this is, again, just a little bit of a warning sign that, people are, the S&P 500's done 14, and I don't know the exact number, so don't quote me on this. 13, 14% over the last 10 years. Why wouldn't you invest in the S&P 500? Again, there's a lot of warning signs. You can't expect. We always say past performance is no guarantee of future results. That the S&P 500 very well could average 3-4% over the next decade. It's a very real possibility. You got to be cautious of it.
That's right. Let me open the phone lines here. 866-577-2473. That's 866-577-2473, and that will get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. But Chase, so many lessons can be learned here, and people have gotten into investing for the wrong reasons.
It's not investing.
Speculating. I guess
speculating, trading. It's. I mean, I hate to say it, but like technical analysis, that's not investing because you're not looking at the value of the business. You're looking at the movement of the stock price. That's not investing.
Right.
That's watching a computer and looking at what the stock price is doing. You could buy a terrible company that the stock price is moving based off technical analysis, and it's, again, a terrible company. That's not investing. You wouldn't consider that investing.
Yeah, and there's just so many things that people, and they think it's so easy, and when it's easy, it's like it's not going to work. I'm sorry.
Can you imagine? Let's just say you can't go see a house. All you can see is the prices of the houses and how those prices have been moving. No, you can't go look at the house, though. You're just going to buy the house based off the prices and how they've moved. That sounds crazy, doesn't it?
Isn't that what's kind of happening now? I mean,
I guess you're right. You break it down there.
There are, they do see, I guess.
Virtually
they see the house. But to never even go into the house, actually touch, walk through it. I forget the number, but there's people actually doing that. And another craziness is the housing market. Too much money out there. And what's going to happen, that's going to cause the inflation, which is going to cause rates to rise. It's going to take money back out of the economy. And then people that did silly things with their money, they're going to lose. Now, again, I feel if you bought – I talked about this on KSI last week about how to, deal with inflation. You want to buy companies that will benefit from inflation. Well, what is inflation? The rising cost of goods and services. So if you invest in a business that's going to benefit from that because their prices are going to go up, then you're going to participate as well. And I want to warn people that is not going to happen right away. What generally happens when you invest in a company during rising interest rates, rising inflation, is that generally will pull back a little bit because the concern comes in like, oh my gosh, rates are going to rise. And then what happens, quarter 2, 3, 4, 5, no, 5 quarter, fourth quarter, all of a sudden, they're starting to benefit where their earnings and sales are starting to rise because of inflation. So do not think that just because you bought a food company that benefits from this, that your company's going to go up immediately. This is why when we tell people when we buy something, we buy it for 3 to 5 years. So this is the important part where people, many times in investing, what's the saying, a little bit of information is dangerous. There's so many ways that Wall Street can flip you upside down. And you've got to get away from Wall Street, and you have to look at true investing to say, yeah, I know this company's going to go up and down, but where's it going to be 3 to 5 years from now?
Yeah.
So, all right, phone number is 866-577-2473. That's 866-577-2473. I kind of mentioned inflation, but let's talk about inflation a little bit. The Federal Reserve is missing, I think, the real inflation. Do they not see that year over year? Like, for instance, pork chops are up 9%, along with other food items seeing substantial price increases. The big one that people may not realize is that inflation is, as I said, the rising cost of goods and services. And we all know the large increases in home prices. But there's something that they're kind of missing on that.
Yeah, the interesting thing is home prices, well, that's not included in the computation for inflation. The price of an existing home was actually up 17% in March. And as we kind of talked about, the housing market's gotten crazy. And, that's where money's going. And you're seeing that the Federal Reserve actually doesn't view housing as a good or service, essentially, but they actually view it as an asset. So that's why it's not included in that calculation. They do look at the cost of rents and housing, however, but rental prices generally lag housing prices by about 12 months. And I also said mix in gas prices into the picture here because they remove gas prices and food prices from core inflation because they're so volatile. But that's still money going out of your pockets into something. I mean, I think that true inflation, taking in all of this other data, is going to be quite prominent over the next few years.
And also, too, they can't do this. It is the average inflation. But one thing, too, is that a person 25 could have different inflation than a person at 75 because their consumption is different. A person at 25 to 30, they're trying to buy a house. They're trying to rent. Where a person at 75, they may own their house outright, and they're not part of that market, but they may have more medical costs, which are rising, which the 25 or 35-year-old may not have that. So that's the other thing, too, is that your own personal inflation could be much, much different there.
Yeah, and I did want to just kind of touch on this housing component as well. It's interesting. I mean, you think through it, it makes sense that the rental prices would lag housing prices because you have new people buying, like, we'll say, investment properties. Well, I bought an investment property. Well, my mortgage is now this, so now they have to kind of raise rent. And the other people that have rental properties will now look at saying, actually, they're now getting this for rent. Now I need to adjust my rent as well to be in the market. So it kind of makes sense on that. But the interesting thing is the largest component for the CPI, the core CPI, is shelter. Yeah. So if this starts to trickle through to rents and into the way the Fed looks at housing, I mean, you're going to see core CPI, I think, just skyrocket. I mean, 17%. You can't have housing prices go up 17% and not have rents go up somewhere near it. I mean, that just makes no sense.
And it does supply demand. I'm sure you drive around San Diego. Right off of 15, they built, I don't know how many apartments it was. I think they just finished that maybe last year. I believe it was like 1,000 apartments right off of 15 and Mesa Boulevard. Now there's another apartment complex being built off of Scripps, what was that street? No, Carroll Canyon, I think. Yeah. So I'm seeing a lot of apartment places going up. Now, what's going to happen is that right now demand is high, but the supply is being built. Same thing with housing. So houses are being built where the supply in a year or so could be much higher, and then rents could stabilize or go down. Yeah. So you've got there's no better economic tool than supply demand. It always works out eventually.
Yeah, no, I mean, absolutely. And it's something to kind of always look at. And, I always tell people, they're like, oh, do you always think renting a home is better? 'Cause, I mean, you and I both rent at this time.
Right.
I'm like, I would not buy a house right now. It makes no sense. And I'm like, no. I mean, there are times where buying a house makes more sense than renting. If rents, on the other hand, went up 17% and housing prices may be stabilized, well, now you got to look at the price to rent ratio. There's all these different things you can look at to see what's the better value. But a lot of times people look at housing as kind of more of an emotional thing, and rather than like, why would I look at the price to rent ratio when I'm buying a house? Well, because it could hurt you down the road if you overpay for a house.
Yeah. And again, you get that emotional feeling that feels good to own your own home, and it feels good, but from a strictly financial, basis, right now, I think people are far better to rent than to buy, because even somebody in an office selling their home, it just goes up and up and up, and just like it's ludicrous. And
oh wow, I got another offer. Oh, and now you get people in bidding wars, and all of a sudden you're like getting. I think she's getting like way over asking price.
Yeah, and it's because it's just like, oh, here's a house, let's buy it, and eventually that game will change as well. So I'm glad that they are selling to get out, because, and again, it like Bitcoin, it could go higher, but there is going to be a point where it's going to like drop like a rock.
I just realized,
what?
After she sells her house, our whole office will be renting. Nobody in our office will own a home.
Oh wow, I guess that tells you something, that we, believe it. And I would buy a home the same way I'd buy an equity if I could find a great deal. I mean, a truly great deal.
Yeah. Where
the house was. This is one house that I got to be careful how I say this, but there's one house that I missed it because the gentleman paid $7 million for the house. Make sure I get the number. Yeah, he paid $7 million for the house. He put $4 million into it to remodel it and do everything else to it, and he sold the house for $4.9 million. That's a type of deal I want to get.
That's what you need. Yeah.
And it was an athlete that did that, by the way. So you want to find somebody that's so crazy with their money that they'll like, yeah, just go ahead. I don't care.
It's not worth the hassle anymore.
Yeah. So that's the deal I want to buy if I'm going to buy a house. I am not going to pay up and up and up. But again, look, he lost what? He lost a total of $6 million?
Yeah.
So I don't want to do that.
I mean, it happens on not even the high end, too. It does happen on the lower end as well.
Yeah. Well, I knew that one because I
mean, it was in the news. Or not in the news,
but
it was pretty well publicized.
Yeah. So that's what it was. All right, phone number is 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Tim. Tim, you're on the Smart Bet Show. Brent Chase, how can we help you?
Morning, guys. I was thinking that the online gaming sports betting might be taking off over the next year or two, so I started looking at some of those companies. I was wondering if you guys could look at Golden Nugget Online Gaming, GNOG.
Yeah, and I'm going to have Chase look at this because I know this used to be in Las Vegas. It was an actual casino, so I wonder if they sold the casino just doing online gaming. So I'm going to look at this here. I'm going to have Chase look at that. And I looked down immediately, unfortunately, Golden Nugget Online Gaming Incorporated, symbol is GONG. I looked down right off the bat, not very much information at all. No PE ratio, no price of sales, no price of book value, no valuation ratios at all. They do not pay a dividend. No sales growth. I do see earnings decline of 245% year over year versus a negative 23 for the industry. They do have a current ratio of 1.8 versus 1.2. That is something good, but I'm just missing a lot of data here, and I'm wondering if this was a spinoff from the Golden Nugget, and now they spun off this small company for online gaming. Chase, are you coming up with anything at all, or?
Yeah, I mean, I just kind of looked at what the company does here. I mean, they do operate, it just says online gaming and digital sports entertainment, so it doesn't look like they have any physical properties. Right. It is based in Houston, Texas, so I do wonder if it is, of course, different from the Golden Nugget casino there. And they also, it says it offers patrons to play their favorite casino games and bet on live action sports events in New Jersey and Michigan, so not even in Texas. It's very interesting. So I don't know. It's interesting, but I can't get a lot of information on it. It's weird too. I'm not seeing a whole lot, but the market cap's $1.1 billion. I do see the 52-week range here. The low was $9.79, and wow, the high was $27.18. current price, $14.72. So it's been all over the place. And I think a lot of people might have the same idea there, Tim, is, the future of this. And then it's like, I made my profits. I gambled a little bit. I made it. So I'm going to take money off the table, preserve it. I think people are gambling with this gambling stock because I do see going forward next year estimated profits, there are none. Estimated to be a loss of 50 cents. So don't like when a company doesn't have a lot of information. I definitely think, as I said, it's a gamble.
You said the market cap was 1.1
billion.
1.1 billion. Well, here's some interesting facts for you, Tim. Total assets for the company, $178 million. Total liabilities for the company, $868 million. Total liabilities gives you a net worth or a negative net worth of almost $700 million. So I think because of the whole hype on gambling and online stuff, this stock is really being pushed up. There's nothing backing this up at all. So and again, this could go crazy. It could go to, it's gambling. It could go to $20, $30, $40 a share. But I cannot justify at all anyone buying this as a business with a negative equity of, $700 million.
Yeah, a couple things. I wonder if they have to save that money aside to pay out their bets if they end up taking a big loss. That's why that's there. And then the other two cities they're in, that's where the legislature has already okayed like sports betting online. And that's why I was thinking if it spreads throughout the nation, they kind of already have their foot in the hold, but not with that kind of negative return.
And also, I just noticed something else on the balance sheet. As I said, they have $77 million in short-term investments. However, in the third quarter of 2020, which was September 30th of 2020, they had $900,000. So I think they had to
pay out some money.
Borrow something, do something there because, something had to happen there to raise that cash. So very, very risky, very speculative. And again, if you want to gamble, I always say go to Vegas and get the free drinks at least.
I just wonder why it's still in Texas. I don't know if Texas is one of the states that's talked about it. I feel like you would have started and headquartered in the state that already offers it, but I know New Jersey's not super business friendly, so I get that one. But
right.
I just feel like Texas is a weird spot. I guess it's in the middle of the country. That's a benefit, and they're business friendly.
Business friendly, that could be it too as well. And I know it used to be, where was it? People in Delaware. They would incorporate in Delaware because the laws are more favorable. Maybe now it's Texas. But, Tim, I think you've called him before. This is probably the most wildest company I think you've called in about. So if you want to gamble again, I guess you can do it, but I wouldn't recommend it. All righty?
No, I stay away from the ones that you tell me are way too much of a gamble, and I do just take my money up to Vegas and get my free drink.
There you go. And then, then what happens? You get your free drinks, you're drunk, you don't realize how much money you lost.
Yeah, until you wake up the next morning.
Yes. Oh, look at the bank account. That's no fun.
Yeah. All right, guys. Well, enjoy your Saturday. I'll talk to you soon.
You too, Tim. Thanks for calling. Bye-bye. All righty. That does open the phone line. 866-577-2473. That's 866-577-2473. And I was going to say, Chase, you have anything on Facebook? But we had a problem hooking up Facebook this morning. So if somebody is on the radio side trying to get it to Facebook, it's not working this morning.
Yeah. Technical difficulties.
Yeah, we had a few this morning. Alrighty, let's talk to our financial planner, Harrison Johnson. Wants to talk about the new tax law, I believe. Harrison, good morning. How you doing?
Good morning, guys. I'm calling in from Scottsdale, Arizona. I'm at a bachelor party right now. Called me.
Now, wait. You're at a bachelor party. Now, this cannot be the most fun you're having at the bachelor party, being on radio talking about taxes.
Well, Chase called me this morning. I was like, I forgot it's Saturday. I got to call him.
Well, I hope the bachelor party improves from here. But tell us about the tax situation, because there's a lot of things in the air that are kind of concerning people. So what do you got to say about this?
Yeah, so, this is something that we've been watching all year long because we know that there's going to be probably some legislative changes in the tax code coming up. So this last week we got some more information about what that could be. So one of the things I would say that none of this is really a surprise. It's been talked about, but they've kind of narrowed down where they're targeting. So one of the things is a higher top tax rate. So currently the top ordinary tax rate is 37%. They want to increase that to 39.6. So that's a 2.6% increase. So a little bit increase there. That's what it was before it got reduced to 37 starting in 2018. This, however, would not kick in until taxable income of around $523,000 for a single filer or $628,000 for a married filer. So it's the high income people that they're going after here. So that's one of them. Another one, we could see some changes in capital gains. So currently, the top capital gain rate is 23.8% when you include the Medicare surcharge tax. And so what they want to do is, for people with income over $1 million, have that taxed at ordinary income rates, which will probably also still include that surcharge tax. So that would be a top rate of 43.4%, so almost doubling with the current capital gain tax rate. So that's one that a lot of people are worried about. But again, it's just income above $1 million. So some people, or a lot of people, would be able to avoid that. Another one that has... Yeah, go ahead.
Yeah, I was going to say, you just brought up the thing I was going to say is that when you say high-income people, I'm glad you defined high-income people, because I was going to say this really affects most people with incomes above $1 million. And that's very important because we went through our clients to see how many clients have above $1 million, and we'll be doing something maybe a little bit different for them. But so important to understand, don't get too upset about this if you're making, I don't know, $150,000 a year maybe.
I will say, too, you said the top rate's what, 43.4%? What would you say the top rate was, Harrison?
Yeah, that's what it would go to, 43.4.
That's what it would go to. And then, in our state of California here, they've talked about 16.6% would be the top rate. So you're looking at a tax rate over 60%. And I know we talked about it as well, Harrison, was the people that this could really hurt is people with small businesses.
Yeah.
Well, that's a good point, because what'll happen if only something like that gets implemented is people will just not sell assets. They'll hold on to everything to avoid realizing those gains, because this is just on gains, and you don't have that tax until you realize it. So if you have businesses, you have a lot of stock, and you're high income, you'll just continue to hold on to it. So from the tax code perspective, if taxes go up too high on the capital gains level, that could actually reduce tax income, that will reduce the taxes that the government is able to collect, because people will just decide not to sell anything at all. So if something like that were to go in place, it would probably also have to be implemented with that elimination of the step-up in basis. So this is another thing people are concerned about, because essentially what that would do is, if you try to avoid the capital gains by just never selling, well, then when you die, then the taxes would be levied against your estate, and everything would be realized, and you'd have to pay taxes at that point.
That's what I think I'm most concerned about, is the step up in basis. I mean, that affects people with real estate, with stocks. I mean, farms. I know people talk about that one as well as small businesses. I mean, that's one that I'm most concerned about.
Yeah, on to that point, I thought it was actually interesting, because one of the things they talked about this last week was putting an exemption on that for family businesses and farms. So if you have a family business or a farm and the family continues to run that after your death, then that could potentially be excluded from that step-up in basis realization event. So hopefully, if something like this does go into place, that is available, because I think this could really hurt a lot of families, a lot of farms, and I just don't think it'd be good overall for our country.
Yeah, a lot of things, and there are things I don't think will come on through. And we kind of look at this. I'm trying to be prepared a little bit, but I wouldn't get too excited about it, because... That's
another good point. Yeah, I think a lot of this stuff potentially will not make it through. The administration is trying to do so much with their infrastructure plan, this tax plan, COVID stuff. There's so much. So a lot of it I don't think will actually make it through.
And I did think sometimes the media does hype things. And it's possible, but they said, this could be retroactive for 2021, which would be terrible because you had no time to plan for it. But I just don't think that's coming through. And I could be wrong. I mean, it's possible, but, it's possible that we get snow here in San Diego as well.
That happened before, right? Years ago.
I think you're right. I think it did. So maybe, and again, that's what I mean. It's a possibility, but it's like slight possibility. So, but yeah, it's good to know about it, but don't get it too emotional about it, because then you start making poor decisions. And I think people, I'm going to sell all my stocks. It's like, no, don't sell all your stocks unless they're overpriced.
Right. That's right.
Did you have one more point there, Harrison? I'm sorry, I kind of interrupted you there. Did you have one more point?
Not necessarily. I mean, the whole idea is we want to make wealthy people pay their fair share and target rich people and all that. But if a lot of these things make it through, you're going to see families, middle-income families that pay absolutely no federal tax with all the child credits and all the breaks that they're getting. So it's really going to be only wealthy people are going to be paying tax and nobody else.
Yeah, and the other thing too that people, politicians, just irritates me. Do they think that the wealthy people are going to do the same amount of sales they did before? And Wall Street Journal is a great article saying that it's been proven that doesn't happen. That when you raise the capital gains tax, well, people say, well, no, I'm not going to sell. So it's possible that the government could get less money because before they were getting, the 20% of the capital gains. Well, now you try to get, we'll call it 43%. Oh, I'm not going to sell. And the revenues could actually go down, not up. So that's one thing that the government and many people just aren't very smart about.
Well, because you look at your returns, it's like, gosh, well, I do all this great investing, and my returns are now like 3% per year because I had to pay all this tax. You know?
Yeah.
It limits your overall return. You got to look at after-tax return. You can't look at pre-tax returns because, well, might as well just leave it in the bank at this point.
Right. And we have other strategies that we would use to actually help that somewhat. We can't eliminate, but we have other strategies that are in the back of our toolbox, we'll call it.
Yeah.
That does go through. Okay, well, we're going to do this for our clients with $1 million or more of income. So, and again, with your help, Harrison, you can actually help people also as financial planner get through this crazy tax situation. Something's going to come through. We just don't know where or when. So
that's right.
All right, we'll go have a beer, maybe one or two, but have a great time. We'll see you Monday at the office.
All right, sounds good, guys. See you on Monday.
All right, sounds good. Bye-bye. All right, again, that's Harrison Johnson, our financial planner from Wilsey Asset Management. Give him a call at 858-546-4306. That's 858-546-4306. He is in the phone tree. Or you can go to the website, smartinvesting2000.com. That's smartinvesting2000.com. All right, phone numbers here, 866-577-2473. That's 866-577-2473. And Chase, I want to talk about that workshop coming up on May 20th again at AleSmith Brewery. Had a great time last time. People learned a lot. It was just a good workshop. And we talk about things to really help you understand. We talk about the craziness of stocks. We talk about the taxes. We talk about all these things. Well, it's like the radio show. And if you're saying, well, I'm not sure what they're talking about, the workshop helps you understand more about the investing that we do and how we help our clients and what I've been doing for 42 years here investing.
And I just got to say, I'm so excited that we get to do another one in person. Yes. Our last one was the first one in person that we've done since February of 2020. So it was more than a year, and we're excited to do another one. And I'm thinking maybe we'll get a better turnout this time because the vaccinations are going up. We're seeing a lot of improvement there, and I think a lot of people are feeling good. I go to restaurants now. I see a lot of people out there. I think we're going to have a lot of fun at that workshop. So it'll be a good time.
And I was at the ball game last night, and I don't know if I should say this, but too late. I don't think it's 25% capacity. There was a lot of people there. But
I heard they're not as strict on like monitoring the upper areas. So I don't know if the upper areas looked because they might be 25% capacity, but it might all be down in that lower area.
Well, and that's exactly what I was going to say because you're right. When you looked up, there's like not many people up there, but down below there's a lot of people there. So, but I still think it was maybe they raised it to 50% capacity because it did not look very empty. And it was just, but on the other side, it was great to go out to the ball game, watch the ball game. I was going to have a hot dog and I had a hamburger instead, but it was just great to be there and be
some Cracker Jacks.
I didn't have any Cracker. I don't like Cracker Jacks. I used to get them just for the toy when I was little, and it's like my dad said, "No, we're not going to buy those anymore." He only wants a toy. So, but no, it's kind of great to see that things are coming back together.
And point being is we're excited to be back, and you've done those workshops for it makes you sound old here, but decades.
It has been decades. Yeah. And so if you want to attend the workshop, because again, I've never had anybody come to the workshop and say I didn't learn anything. People always say like, "Wow, I didn't know that. I didn't know that. It was great." So if you want to come to the workshop, it is free. It's going to be May 20th at 6:00 at AleSmith Brewery, right off of Miramar Road. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Or call the office, 858-546-4306. 858-4306. That's 858-546-4306. Ask for Brianna, or actually on the phone tree, you'll find Brianna, and she'll get you signed up, and we'll go from there.
Yeah, gonna be a good time.
All righty. What time is it? It's about 10 till 9. We got time for calls, so let's head up to Cardiff and speak with Jeff. Jeff, you're on the Smart Investor with Brent Chase. How can we help you?
Good morning, gentlemen. And hey, Brent, it does snow in San Diego County, that is. I wanted to ask you guys' opinion on Qualcomm. I've owned it for years and just wondering where it's at on your radar, if it's time to sell or keep and hold it for a little bit longer. Thank you, guys.
Sure. I'm so glad you called about this one because I see it go across the ticker. We made money off of Qualcomm in the past. We do not hold it currently. But I kind of wonder, like, what is the values on this? So Jeff, I'm so glad you called because I've been wanting to look at Qualcomm and not had the time. Company we're looking at is Qualcomm. Symbol is QCOM. Good start here. PE ratio 19.9 versus 36.7. Price of sales, though, is expensive, 5.3 versus 3.6. Price of book value is not material, but that is the same as the industry. And then price to cash flow, 16.5, just slightly higher than the industry at 15.9. Now, we do see that they pay a 1.9% dividend, use 37% of the earnings to pay that out. Here's some great news. Their sales are up 47% year over year. The industry is down 0.9, and earnings per share for Qualcomm did climb by 107. The industry fell by 17%. So good news for Qualcomm. The next thing is very disappointing to me. Their balance sheet, now they have a current ratio of 2. That is better than the industry at 1.8. But I don't know when they took on all this debt. Their debt to equity now is 212. I mean, they used to be like a low debt company. I don't know what happened, but I do not like high debt companies, and I don't know if they're using it to buy back stock. Gosh, I hope that's not the case.
I think they've bought back a lot of stock.
Really?
I remember them talking about stock buyback programs and so forth. But like you said, I haven't followed in a couple of years. But that's my inclination there.
That's one thing you want to look into with this company because, well, one, I don't like the high debt, but I really despise, I hate when companies borrow money to buy back their stock at perhaps inflated prices. So check that out there because that could be a definite concern. Now, also strange here, return on equity 153 versus 15.5. And that could be because of the fact they have bought a lot of stock back, so therefore they have low equity. We do see net profit margin 27.3 versus 9.8 for the industry. That's a positive. Receivable turnover is 9.2 versus 5.2. That's a positive, along with inventory turnover. Well, that's only 5.4, not quite as good as the industry at 5.9. Chase, what about the earnings going forward?
So looking at the current price for Qualcomm, it is $138.80. 52-week high is $167.94, and 52-week low, well, that's $74.09. Now I got to September 2022. I see estimated earnings per share of $8.54. Would give us a target sell price of $141.76. So it appears to be about fairly valued. It did eclipse that when it hit its 52-week high. But I will point out, I don't know if this is from stock buybacks or
right,
where their earnings growth is coming from. But if you look at September 2019, they made $3.54. If you look at September 2020, they made $4.19. Then this year, they're estimated to make $7.75 per share. And I said next year, $8.54. I mean, that is phenomenal earnings, right? I'm not going to knock that. I don't know if that's coming from stock buybacks or where that's coming from. But I'm shocked. You look at a company like AMD, they have similar growth, and they're trading at way higher of a multiple.
Right.
I mean, I don't know. I mean, Qualcomm, as I said, target sell price $141.76. Have to look a little closer at the balance sheet, but it may be a hold for you until it hits the target sell price.
Yeah, and I think you want to try to understand why do those earnings go up by, well, almost a double there. That's pretty amazing to me. So that's something I want to understand. But I don't like, again, the high debt that they have. That does concern me. But, again, I think it could be because they have low equity. But still, and I was hoping to be a little more excited about this. Like, yes, maybe we can look at buying this. But, no, it's more of looking at should you be selling this one. So I'd have to say give the answer to those questions, and it could come up with a sell.
Yeah.
So you're looking out the window.
I'm just looking at the screener.
Oh, can you see the screener from there?
Yeah.
Oh, I can't see it because I got to turn around every time I see it. Jeff, does that answer your question?
It sure does. Thank you, gentlemen. I do appreciate your feedback. I enjoy the show every Saturday. and I think I'm going to hit you up and get in touch with Harrison soon. So thanks, gentlemen. Have a great day and weekend.
Well, that sounds good. We look forward to it. Have a good one.
We got a few minutes here till break, but looking at Qualcomm and when you're talking about stock buybacks and companies borrowing stock, and we haven't really had this conversation. I thought it'd be interesting to have. I almost think that right now, if your stock is fairly priced, to buy back stock and borrow money, I'm not saying go to 500% debt to equity, but it makes a lot more sense to do it right now when interest rates are so low, and especially if your stock is like trading at 10 times earnings. I'd say if you have no debt on the balance sheet, I think it almost makes sense to borrow money to buy back stock.
And I think the key word is if you're at 10 times earnings.
Yeah.
And that's the hard part. I mean, we are looking for businesses to buy. It's very hard to find them now. There's not a lot of companies I think would qualify in that earnings. But you do make a good point, because I am totally against them buying or borrowing to buy back stock. But if your return on equity is higher and you're only paying, we'll say 2 or 3% to borrow, it could make. And again, that's why there's no rule of thumbs in investing. You've got to look at everything and understand everything, because there's times that, again, you've made a good point that rates are low. Maybe it does make sense. But with Qualcomm being a target sell price around 140, and their PE looks okay at 20.
I guess it depends where they bought back the stock, though. If they bought it back at like $80 a share, well, it looks like a pretty darn good investment now.
Well, unfortunately, a lot of companies do that to boost the share price. Oh, we're buying back, $1 billion here, and let's buy more because we're going to buy it back. And it doesn't make financial sense, because there's been many companies in the past. You look at them. I think of IBM comes to mind, where they did a lot of financial engineering before, buying back the stock at high prices, and it made no sense. And we've seen other companies. Wasn't it Gilead was one that we owned? We did sell at a good price. But I do believe they bought a lot of their stock back at high prices, and it's still not back at that price yet.
Yeah, no, it was a terrible investment. And I mean, I know Netflix, announced a stock buyback. I think that's trading at I forget what they traded at, somewhere like 70 times earnings, where I don't know why you would do that.
Yeah, it is a terrible investment when you actually pay more for your stock than it's worth. And you're doing it just because, and they may say, well, we're not financial advisors. But you are helping people or understand that, hey, we think our stock's a good buy. It's kind of like a thing that if you're going to say we're going to buy it back, you think it's a good buy. And if you have a lot of cash, maybe there's other things you should be doing. Maybe you should be buying another business.
Well, I've talked about this before, but if you trade at lofty valuations, what should be occurring is your growth rate for the business should be, 20, 25%. I mean, you should have high growth to justify your valuation.
Right. Well,
if you're taking cash, you should have better investment opportunities to grow rather than buy back your stock.
Yeah. And sometimes maybe patient. We're patient right now to invest. I think many times businesses should be patient to invest. And if the executives are not, and they just want to we got all this cash, we got to do something with it, or we don't miss this and so forth, that's a company I would not want to be invested into.
Yep.
So I like executives that are very methodical, look at things, not just get pulled into the hype. You really got to look at who the management team is.
Now that's where the conference calls come in. You can learn a lot more about what's going on. They'll talk about we've read conference calls where management says, we think our stock is just the best opportunity right now to do with our cash.
Yeah.
So you kind of find out, you hear from the management. That's why we love the conference calls so much.
Yeah. Phone number is 866-577-2473. We got our break coming up. I do see David in San Diego. I believe that is HUN is.
I think it's Huntsman. I think it's Huntsman is the.
Huntsman?
We'll find out.
Well, David, you're going to be up when you come back from the break. Same thing. Brad in San Diego wants to talk about Apple. We'll talk about Apple. I'd like to do that because now we have new earnings from Apple, which they did phenomenally well. So we'll see. Hopefully we got numbers going forward from the analysts, see what they say. It'll give us a chance to talk more about Apple as well. And again, the phone number is 866-577-2473. You got a stock you want to talk about, we'll do that for you.
And HUN, I don't want to give it all away for you, David, but it is Huntsman Corporation. I know it's a chemical company. So
yeah, I was thinking of Huntington or something, but
Honeywell,
that's what it was.
I think they're HON.
HON, I think you're right. Yeah.
Yep.
On the workshop, well, we don't have time to talk about that now. We'll talk about the workshop when we come back because this is something you don't want to miss. It's going to be May 20th at 6 o'clock at AleSmith Brewery. You want to learn about investing. You want to see what we do. That's when you want to go to the workshop. And it's going to be live, in person, like the old days.
And we got a whole nother hour, too, to take your calls and make sure we're answering questions that you have. Again, your calls do come first. Always give you that no strings attached, unbiased. I've made it backwards. Unbiased, no strings attached, fundamental opinion about what you want to talk about.
There we go.
You're taking your calls, questions about stocks, questions about taxes, financials, whatever it might be. We're here to help you out.
Stay tuned. We'll be back.
Join the new and improved K-Praise Fan Club.
Join the new and improved K-Praise Fan Club at kprz.com. And don't forget the K-Praise app. It's free in the Google Play Store and Apple Store.
Subscribe to become a member today by visiting kprz.com. It's that easy.
KPRZ, San Marcos, Poway, and K29CR, Encinitas. K-Praise.
All righty, welcome back to the Smart Investing Show. Gosh, that's a quick break here, but phone number is 866-577-2473. That's 866-577-2473. And Chase, I think we teased on the workshop, but didn't tell people how to sign up. What you can do if you want to attend the workshop on Thursday, May 20th at 6 o'clock at the AleSmith Brewery, go to our website, smartinvesting2000.com. That's smartinvesting2000.com, or call the office 858-546-4306. That's 858-546-4306. Brianna, she'll get you signed up, and we look forward to seeing you on May 20th at AleSmith Brewery, 6 o'clock. Great time, great information. They got great food there for you, and they also have beer. Great beer as well. Yeah,
and I'll probably have a beer with some people after the workshop.
We did that last time. Yeah, it was kind of fun, and just kind of had beer and had some food, and it was great.
Yep.
We closed the place down, I think.
I think we did.
Don't get too excited. They closed at, 9? All righty, let's go back out to San Diego as promised and speak with David. David, you're on the Smart Investor Brand Chase. How can we help you?
Hi, guys. I always enjoy your show.
Thank you.
I was looking at Huntsman. I own it. My cost per share is about $9 and change. But one site had the PE as 6 point something. Another had it at 25. So what the heck is going on with that?
What was the site that had it at 6 something? Because I do see the 25. What's the site that had it at 6?
I can't remember. It was something on my phone, so pulled it up, and I thought, holy mackerel, 6. I don't remember it being that low.
Right. I mean, 6, we'd be all excited. We were saying, hey, we want to buy this company. So I think 6 could have been an error. Sometimes we have seen.
See, Yahoo Finance has it at 6.
They do.
Yeah.
All right. Well, let's go through because you're going to look at the earnings. I'm going to go through the numbers, so that is kind of a strange thing. So what I'm going to look at here is Huntsman Corporation, symbol is HUN. As we said, the PE ratio is 25, which is better than the industry at 37. Price of sales, 1.1 versus 2.7. That is good. Price of book value, very good, 2.5 versus 31.7. And then price of cash flow is 11.1. That, too, is below the industry at 16.1. So valuation ratios look pretty good for Huntsman here. We do see the dividend yield is 2.6% currently. They use 56% of their earnings to pay that out. Now, unfortunately, year-over-year sales are down 11.5%, which is not as good or worse than the industry decline of 5.8%. Same thing with the earnings, down 33.5%. The industry saw earnings gain of 23%. Balance sheet for Huntsman does look good. Got a current ratio of 1.8 versus 1.6. Debt to equity is 61 versus 81. That is a positive. Return on equity, 8.4, not as good as the industry at 12.5. And we usually like to see somewhere around 15 for return on equity. Net profit margin, 4.8, also below the industry at 7.3. Receivable turnover, 6.5, better than the industry at 6.3. Inventory turnover the last 12 months, well, that's 5.6, about the same as the industry at 5.6. Chase, what do you got for the earnings going forward?
Yeah, so current price here for Huntsman Corporation, well, that's $28.67, near its 52-week high of $29.79, and well off the 52-week low of $13.86. Now, I did a little digging here, and I think I see why the PEs can be different in different places. The non-GAAP earnings were 98 cents for 2020.
Right.
I'm kind of surprised by that because the GAAP earnings were $4.66. Most of the time I feel like it's reversed where Yahoo will pull the non-GAAP earnings for the PE ratio. So a little bit surprised by that, but my guess is maybe they had some sales of a business, or another thing, I wonder if they hold oil on the balance sheet where they might have written things up, or there might have been something going on there. But my best guess is that was not from true operations to have that differential. And if it was, that would have been included in the company's non-GAAP earnings. I can bet you that.
And I do believe that Yahoo does use non-GAAP pro forma type numbers, where Reuters, I do believe, uses GAAP most of the time.
But that's the weird thing.
Right.
Is it the GAAP is higher than the non-GAAP here?
Right. And I think Reuters is using, well, they'd be using the non-GAAP. Right.
So it's weird.
That is weird. Yeah.
But I guess we know where the 6 versus 25 is coming from. It's just weird that the valuations are a little bit different. And that's where, of course, coming in and understanding the PE ratio is so important, because a lot of times companies can back things out. We want to understand the PE there. But to give you an answer on that target sell price going forward, I do see in 2022 the company's estimated to make $2.56. Would give us a target sell price of $42.50. Well, that looks good. I like chemical companies. I think they're an important part of society. I do wonder how oil is going to impact this company, though.
Yeah, because that can be a factor in chemicals, the use of petroleum. But I would want to understand, David, more about those numbers and why the big change from GAAP to non-GAAP, because was it a sale of a building or a business or something? That would be almost non-eventful, given that lower PE. The 25 would be more like the real PE. But it's just, and I think percentage-wise, what does it make up on your portfolio?
Less than 1%.
Okay. So, because you said you owned it a while at a lower price, I just thought that maybe you had a bigger percent. But I'm kind of confused on it. I'll put it that way. I almost want to like it because of the low PE, but I would want to look at more on why the big gain on the GAAP side.
On the GAAP side, and the oil is a big question for me. Also, it is near its 52-week high, so you already hold it, but if somebody's looking at buying it, I would be patient on a buy-side type acquisition there. But, yeah, there's just some questions that I have on it. I mean, the numbers look good, but...
And it's a chemical company. What type of chemicals do they have? Do we know? Did you look at it?
Primarily paint.
Paint.
And, for the chemicals that go into for the different colors of paints and things like that. So it's kind of wouldn't say a unique business, but I don't think it's not like a Dow or anything like that. Right. I don't think they're into gardening stuff and that kind of chemicals.
Yeah, so paint is one that I think about. It's probably doing very well because of the rebuild, we'll call it, in the economy, which we think could maybe slow down a little bit as the summer people say, well, I'm not going to put that new porch on the house. I'm going to go to Hawaii. Yeah. So that was one thing kind of worried me, that maybe you'll see the paint sales dry up a little bit. All righty, David?
Oh, okay. Thanks for the info, and best of luck to you.
Well, thank you, and you have a great weekend. Bye-bye. All right, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's head out to San Diego and speak with Brad. Brad, you're on the Smart Investor, Brent Chase. How can we help you?
Hi, Brent. Brad Schumann. Hope you're doing well.
Good. How you doing?
I'm good, thanks. I had a question about Apple. With the great earnings that came out, stock is a little flat right now. What's your take and your opinion on Apple, and do you have a target price for them?
Yeah, and I'm glad you called about this, Brad, because I know they had great earnings. When Thursday, I think they came out. I think their profits were up, was that 80%? I think it was. It was something.
There's so many, yeah.
Yeah, it's just phenomenal earnings, and I do see that Reuters. We do have the new information for March 27th, so we got new numbers here. So let me kind of run through the numbers here and see what we can come up with. Again, the company is Apple, symbol is AAPL. We do see a PE ratio of 29.5 versus 36.7, so that's a positive, being below the industry. Price of sales, 6.8 versus 3.6. That's a negative, being higher than the industry. Price of book value, 32 versus non-material. And price of cash flow is also expensive at 25.3 versus 15.9. Now, because of the huge increase in the stock price, their dividend yield is now only 0.7%. I think at one point it was about 2% yield. It's now fallen because of the rise in the stock price down to 0.7. And they only use 18.6% earnings to pay that out, so they could increase that if they wanted to. We do see sales were up 21.4%, industry down 0.9. Earnings per share year over year for the last 12 months were up 39.7. Industry was down 17.5. The balance sheet is looking a little bit tired here, I'll put it that way. Current ratio 1.1, below the industry at 1.8, and debt to equity for Apple is now 180 versus 72. So that's kind of high on the high side. I don't like things above 120. We do see return on equity is of 103 versus 15.5. I think that's because they have a really low equity. I think they bought a lot of stock back, reducing their equity quite a bit. Net profit margin, 23.5 versus 9.9. That's a positive. Receivable turnover, 19 versus 5. Very good there. And then inventory turnover, 46. Well above the industry at 5.9. Chase, what do you got for the earnings going forward?
Yeah, so current price here for Apple, it's $131.46. 52-week high, that's $145.09. And then the 52-week low is $71.46. I go out to September 2022. I see estimated earnings per share of $5.26. Would give us a target sell price of $87.32. So I know Apple's, it's gotten expensive. I mean, it had a phenomenal, gosh, I'm blanking if it was 2019, 2020, but it just had like a boom year and a half or so, where I think it just got a little bit too far ahead of itself. And again, you can report great earnings, but if everybody's already expecting great earnings, well, yeah, everybody's already expecting it. And the other thing I will point out on Apple that does concern me is I saw they had kind of a negative ruling over in Europe on their App Store. And I know here in the United States, they're kind of going after them for the same issues as well, that they're kind of running a monopoly essentially on that App Store, which could be problematic because that's where a lot of their potential growth is coming from, is that service revenue.
Yeah, I see Apple having a much hard time growing much beyond this. It's a great business, but it's very pricey. Their equity has fallen from $78 billion down to $69 billion, in part because their debt's gone up about $11 billion, from $110 billion to $121 billion. So,
I know they bought back a lot of stock, though, so I think that's coming from that. And if you look at the book value per share, it's probably...
And that's kind of crazy because they do have, cash on the balance sheet. They do have about $69 billion, which is down from $94 billion. But they do... And you really want to look at their long-term investments because they include that in the cash. That is now $134 billion, up from $98 billion. But
I think they announced like a $90 billion stock buyback plan, too.
They did, but the point I'm trying to make is that I think they use, like us, we're not having everything in cash. We're not using cash equivalents. I think on their long-term investments, that could be part of what they're doing as well, trying to get some type of at least a 1% yield versus sitting in cash. So,
if they leave it overseas, that's still also a long-term investment, not a cash.
True.
You said their target price is $87?
Correct.
Yeah. So,
it's just expensive. It's very, very pricey.
And the problem with Apple is that it is a great company. Everybody loves it, and that is what creates the premium on the stock. That will not stay there forever. And could it go on Monday? Perhaps. Could it be here a year from now? Perhaps. But it's just not. It's one that we would not hold because we are conservative. We don't like to hold things overpriced because sooner or later it will drop. Brad, how much percentage-wise is in your portfolio?
About 3%.
Oh, okay. So I mean, if it were to drop, it wouldn't hurt you. But I mean, if we were managing the money, we would not be an Apple. It's just too expensive for philosophy that we use. So, and we've actually,
Right.
I almost got in trouble with the SEC. I was going to tell what our performance was. I can't do that in air. So, but anyways, it's you can do well without Apple, and I'm just concerned that it always happens when something's overpriced. One or two things happens. It either falls in price by 20, 30, 40, 50%, or for years it will not grow. And you could be sitting here 5 years from now, and the stock is still at 120, 130.
Right. I mean, with what you're saying on a target price of 87, it's at a 131 now. That's a large decline.
Yes.
Yeah, and I mean, it doesn't necessarily, as Brent said, mean it's going to drop down to $87 a share. It just tells us that it's overvalued, and things can trade at 20, 22 times earnings for years. It just, could it expand to 30 times earnings? I don't see that as a likely probability. I mean, it could happen, but I think it's much more likely that it trades sideways or falls than it increases 100% over the next 5 years.
And also, too, Apple is one of the high-tech companies that they're saying will have difficulty as rates rise. And you see it when the 10-year Treasury goes up, Apple, Netflix, Amazon, they all drop. And if rates were to go from, we'll say, in the next 2 years from 2% to 3%, perhaps Apple could be trading at $80 a share then. So it's very pricey. All ready?
Okay. Hey, one more question?
Sure.
Okay, WY?
WY.
Yeah, Weyerhaeuser. With the infrastructure American Jobs Plan that our president is proposing, I'm thinking that the steel and copper, aluminum, and wood are going to be industries that are really going to excel in the near future. What's your take on that one?
Yeah, just conceptually, because we've got other calls waiting, but conceptually, a lot of this is already built into it. When we look at it, and actually the housing market, we talked about this before, lumber is up from like, I think
400% or something.
Yeah, 400, 500%. So I think that's already built into it. Same thing with steel. And we saw the infrastructure bill, a lot of it is not going to be for building. It's going to be for other things as well. So you may not get as much steel uses as you want there. And these companies are not on sale. The time to buy was like a year ago.
Yeah, I'm going to say, too, Brad, if you want us to actually break that down, look at the numbers closer, give us a call next week. As Brent said, we do have other callers, but it could be an interesting one. So maybe give us a call next week, and we'll have time to break that down for you.
Yeah, that'd be great.
Okay, I'll talk to Harrison or one of you.
All right, sounds good. Have a good one, Brad.
Okay, thanks, Brent. Take care.
Yeah, you too. Bye-bye.
And I was going to say, too, I was just thinking on Apple. I remember looking at it like last year, but if you looked at their net income growth, it wasn't very good. A lot of their growth on the earnings per share has actually come from stock buybacks.
Oh, you're right. Yeah.
And it's so weird with Apple, too. For years, it traded at like 12, 13, 14 times. Oh, it's just an iPhone company. It's too cyclical. And now all of a sudden trades at, gosh, I don't know what, but at one point I know it was trading around like 30 times earnings. I mean, it's crazy how the market can shift, but the scary thing is it can shift back to, maybe in a couple of years Apple, 50% of their revenue still comes from iPhones, so they're going to trade at 12 times earnings. Great, we'll buy them back.
And companies do falter somewhat. Yep. They fall out of favor. And it's funny, we went to dinner on Wednesday night with a good couple of friends of ours, and they were taking pictures like, wow, is that the new iPhone 12? The pictures are great. They go, no, it's a Samsung. I go, really? So, I mean, there is competition out there, and it can change. I mean, at one point, Intel overshadowed AMD by a large margin, and look what AMD has done over time. Yeah. So, I know there's other phone companies out there besides Samsung, but still in all, I mean, everybody wants that share of the market, and they may come out with something better than what Apple has, and,
And people know we're not big fans of Tesla, but I give Elon Musk credit for creating a car company. And I mean, you go back, 15, 20 years ago, nobody had really started a successful car company in decades.
Right.
And, you never know. Could there be a Tesla in the iPhone market that comes in and steals share? It's a possibility.
Yeah. I mean, you're not top of the hill forever, and that's what worries me. And when things are kind of pricey, and Apple could do well for the next 12, 24 months, but sooner or later. And the thing, too, that people don't look at, we've talked about this. We sold a company, I think it was last year. We sold it at a good price. I think it's slightly higher now. Like, oh, you sold too early. But from those proceeds, we took that money and bought another company that's done extremely well, far outperforming what we would have done had we held on to that company.
Also, too, what happens if all of a sudden we don't need phones anymore and it's like an earpiece and you just all of a sudden can, hey, call this person, and great.
Right.
You're good to go. We don't need a phone anymore.
And I think that I've heard that that's going to happen. And the thing is, will Apple be the one, or will it be somebody else who we've not even heard of yet that comes out with that? So
things change is the tough part.
Yeah. So never overpay for a company, which includes holding on to a company that's overpaid. And I'll never forget, early in my career, the guy came up with this philosophy. I don't know if he heard it from somebody else, but he goes, if you wouldn't buy it now, why are you holding it?
Yeah.
It's like, yeah, it makes a lot of sense, you know. And a lot of people say, "Oh, I would never buy it now," but you hold it, then sell it and buy something less expensive. And so, alrighty, phone number is 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Tony. Tony, you're on the Smart Investor Show, Brett and Chase. How can we help you?
Yeah, hey guys, just love the conversation today. Real quick on Apple, my investment club held it many years, and when you talk about kind of certain things in the news, when they transitioned from Steve Jobs to Cook as CEO, you know, there was a lot of angst in the news. Oh well, it's their innovative days ended. We are so glad we didn't listen to that. I mean, we've made a ton of money off of that Apple stock. So, anyways, and we do still monitor it. We took our initial, investment out of it, and we've just let the profits run. And so we're really glad we've done that. I actually called to see
Tony, real quick on Apple. I was going to say back at that point in time too. Apple stock was a value stock.
Yeah,
it is now a growth stock. So it has changed. It has transitioned. So. Big change there.
Well, yes and no. It was in that Cook in the Jobs years. It was really, toward the tail end once they came out with the, the music and all the other, they were no longer just a computer company. They really took off as a growth stock. But
in the early years, you're right.
So,
Well, there's an interesting point in time where they were growth and value too.
Yeah.
It was interesting. They did fit kind of the mold for both, and I mean, they were a value company because they traded at low valuations. I remember we held it for years, and same time with Tim Cook and Steve Jobs, and it was, oh my gosh, and it's like, well, they have the products. All Tim Cook has to do is not mess it up, basically.
Luckily they've continued to innovate, and so will they, maintain that corporate culture after Cook, when whoever his successor is, that's
how old is Tim Cook? I wonder what his tenure is going to be here.
I don't know that, but I'm guessing another 4 or 5 years, but that's just a guess.
Casey's 60 on the dot.
60 on the dot. Okay. He's still a young man because I'm 65, so I'm going to call him young.
There you go, guys. I love it.
So Tony, how can we help you there? I'm sorry. Yeah. Go ahead.
Oh, no worries, guys. I really do enjoy the conversation. Listen frequently nowadays. So Chase's stock from his youth, Lamb Research, it recently reported record quarterly results. And I know I talked to you guys some months back about this one, and I just kind of wanted to get a sense from how much weight or emphasis do you look at quarterly reports as opposed to, and I know you look at both, but when I look at this one, record revenues, record earnings per share, and their current PE, at least in what I pulled up, is 26. And in that industry, do you really consider that too high or overvalued? I know that was our discussion, months back, but now with the recent report, the recent data, what are your thoughts?
Well, Tony, let's look at all the numbers here for Lamb Research. The symbol is LRCX, and you're correct. The PE ratio is 26.2, but you compare that to the industry, it's at 40.3. So that does look like a bargain compared to the industry. Not the same hold true for sales. Sales are 6.7 versus 3. Price to book value, 24 versus not material. And price to cash flow is expensive at 25.5 versus 19.4. So you look at all the valuation ratios, well, it's not really the great deal compared to the industry. I do see they pay a 0.8% dividend. They use 21% of their earnings to pay that out. We did see sales are up 38.1%. The industry is down 4.4%. And the earnings per share climbed by 70.3%. Industry down 14.1%. So the company's doing a very good job compared to the industry so far. We do see on the balance sheet, current ratio 3.1 versus 2.1. That's good. Debt to equity 108 versus 50. Now, I'm okay with 108 debt to equity as long as I see maybe some improvement on cash flow, that they are trying to pay down that debt and not just letting it go up and crazy. And it could be, again, from stock buybacks, reducing the size of the equity. So you got to understand that. Return on equity is 69.8 versus 11.1, which kind of tells me I think their equity is kind of low. We do see net profit margin 26.1 versus 7.4. Receivable turnover 5.3 versus 5.7. And inventory turnover 3.3, not quite as good as the industry at 3.6. And I was kind of concerned about the low inventory turnover, but the industry has a low turnover as well. Chase, what are the earnings going forward?
So current price here for Lam Research, well, that's $620.45. 52-week high, $669, and the 52-week low, $229.69. I go out to June 2022. I see estimated earnings per share of $32.42. Would give us a target sell price of $538.17. Again, that's using our 16.6 multiple, and that doesn't necessarily mean that it's going to fall back to 16.6. I mean, right now it trades at about 19 times future earnings. I'm going to say that's not that bad. I mean, I say it's not that bad because you compare it against the whole stock market.
Right.
Well, that's not bad. But the problem is we use the long-term average because everything reverts back to the long-term average over time. And right now, Lam Research, they're trading at 19 times. But I remember back in my youth days when I bought it, they were trading at around 9, 10 times earnings. Yep. So that's the thing that is so interesting about investing is things can go from different kind of variables on that PE multiple. I mean, there's going to be times where it's going to trade at 20 times, and other times it's going to fall back down to 10. When it's at that 20 times earnings, though, I'm concerned that, well, is it going to go to 30 times earnings? I don't think so. Yeah. Unlikely that occurs, especially with the prospect of rising rates going forward.
And actually, back about 10 years, maybe 15 years ago, I actually did have a target sell price using 20 times earnings because it was higher. Now it is lower at 16.6. And again, that's like the average. So we know that things will go above and beyond the average. But again, I want to be conservative. So at 16.6, we say that's when we're going to get out. Does not mean the stock will not keep going. But we feel that, okay, let's sell that company at 16.6. Let's now find a company trading at 10 to 12 times earnings and do better longer term.
Yeah, and when you say you're looking for 10 to 12 times earnings, man, that's got to be really tough nowadays. And are you looking at future earnings or current?
It's future earnings.
Future. Yeah.
Future, 10 times future earnings.
Yeah.
Got it.
Yeah.
Wow.
So things can change. I mean, we always like to look down the road. And I was going to say with Lam Research, I'm quite impressed here. I mean, in 2020, their earnings were $15.95. As I said, next year they're looking to do $32.42. I mean, that's a 100% increase essentially on those earnings. That's phenomenal. But again, I don't want to overpay for things going down the road. And as I said, 16.6 long-term average. That's what we'll sell out at.
And you can actually do pretty well doing that. And there are times that we're going to be beat by the market because the market goes crazy, and we understand that. But I've been doing it, this way for, well over 20 years now, this way. And look, a few tweaks here and there. But it just...
So it sounds like you wouldn't buy it now, right? It's not a current buy, and when you were commenting earlier, if you wouldn't buy it now, why would you hold it?
Yeah. Mm-hmm.
But you're holding it, like what I remember, some of the sayings before is that you make your money when you buy. And we've had it for quite some time, going more than 5 years now. Mm-hmm. So we've seen that we've reaped that meteoric growth, especially in the last year. It's about 8% of our club's portfolio, but it sounds like at some point want to shave off some earnings or some profit and put it into lower PE.
That I look at too. You sell it at 620, maybe it goes to 650, but now you have all this cash. We know there's going to be a pullback. Just can't tell you when. When that pullback happens, well, this is going to drop, but you're not going to have cash to step in and buy something else that maybe is at 10 or 12 times earnings. So that's how we always look at this long-term perspective, 3 to 5 years. It doesn't mean we'll be right next 3 to 5 months, but 3 to 5 years. And that's what I look at as my long-term return is very good. But there's times on months to months or 6 months and sometimes even a year, like, gosh, we didn't do very good. When we look at the long-term time perspective, like, wow, we're very happy with our performance. So that's what you got to look at. It's very hard because emotionally,
it's done well.
Yeah. Well, gosh, it's up 620. I don't want to sell it now. And, but and kind of investment club is something that's a little bit different as well because you got how many people in the investment club?
We have about 12 active members, and we meet, and it's a group. But it's like this, we talk about the numbers, we debate, and it's just so much, it's educational. was the intent. But we've made good money along the way, and so like what we talked about this some time back. If you can learn while making money, that's the best of all worlds. And we have developed great friendships, just really great friendships over the years. Love to invite you to come speak to us, maybe August or the fall when things somewhat back to normal. When you guys are up for it. So
yeah, give us a call. We'd love to do that. All righty?
Mm-hmm. Yeah, thank you guys. Always a pleasure. Really, really enjoy the show.
All right, Tony. Thank you. Bye-bye.
I was just kind of thinking during that conversation with Tony about our multiple of 16.6. And the thing that we talk about is the rising interest rates. And people are like, oh, well, the stock market can trade at a higher multiple now because interest rates are so low.
Mm-hmm.
And that is true. But the problem is, what happens when interest rates start to go up? That's in the future.
Yeah.
Like the interest rates currently, well, now that's all occurred in the past. Now we know interest rates are going to start rising. What's a just multiple there? The multiple is going to have to start to fall as interest rates climb. That's why we just stick to long-term average. You are not going to be able to predict where the interest rates are going.
No.
That's just not going to be possible. So that's why we use the long-term average. We don't try and predict, what's going to happen at that macro type level. We just know, hey, long-term average, 16.6. That's a good multiple.
We do have our predictions on what interest rates could be. Like, again, we thought initially in the beginning of the year that at the end of the year rates would be around 1.5, 1.6. We've kind of raised that now to maybe a 2% 10-year Treasury because data changes. And that's the other thing, too, that I get so frustrated sometimes with, for the next 20 years, it's going to be this. You don't know what's going to happen in 20 years because things change, people change, and so forth.
Did you know COVID was going to happen? Was that baked into your forecast?
Yeah, exactly, yeah. And that's why it's so important to be flexible and understand and stay on top of stuff. You can't just do it now and say, okay, I'll come back a year later and see what happened. No, you're going to miss things. You've got to stay on top of it and be flexible to change with the way things are changing. And that's why I've been doing this for, I think, 42 years now. I still love it. I still get excited because I'm not right all the time. It's very exciting to I don't want to say be wrong, but to say like, wow, that was something different. How do we react to that?
And I'll kind of counter your point there, just saying we do make our predictions. We do have our predictions on, the interest rates and stuff like that. And we're right some of the time. We're wrong some of the time. But it never changes our philosophy. Our predictions don't impact our philosophy whatsoever. We stick to value, even though value's been out of favor for the last decade. We know that you can still do well in value investing. Yeah. It just hasn't been as good as growth. But in the long term, your likelihood of doing better falls into the value investing side. And then also, we have our opinion on the interest rates, but we're not going to say, oh, well, we think that interest rates are going up, so we're going to take our multiple now instead of 16.6, we're going to put it down to 16.2. No, it doesn't really change our philosophy.
And it is funny because the last few years, growth has outperformed us. But I'm by no means embarrassed by our returns compared to growth.
No.
And people are not disappointed with the returns compared to growth. They may even know. I mean, I have clients that have been with me for like 20 years, like, wow, I've done extremely well. And 20 years is different than 10 years as well.
It is. And the other thing, too, is people that do, like I said earlier in the show, I had Tesla, I had this, I had that. Well, yeah, I had like 40% in cash, or, I had bonds, too. So they do the growth, but something else, where we do a pure value strategy where we can outperform people that have been doing growth investing because they do other things.
And Jason, I forgot about the workshop. Because these are things we talk about the workshop. This is stuff that you learn at the workshop. You learn what we've done in the past, what we see going forward. It is free. And again, it's at AleSmith Brewery, May 20th, 6 o'clock. That's a Thursday night. All the things you'll learn about investing so you don't make those emotional mistakes. You don't like, I don't know what to do, so I'm just going to go to cash, or I'm going to buy this because everybody else is buying that. No. When you come to the workshop, you actually learn true fundamental investing. It is free, but you got to sign up. Go to our website, smartinvesting2000.com, smartinvesting2000.com. Hope to see you again Thursday, May 20th at AleSmith Brewery, 6 o'clock. All right, phone number is 866-577-2473. That's 866-577-2473. Let's go to Temecula and speak with Tony. Tony, you're on the Smart Investor, Brent and Chase. How can we help you?
Hey, guys. Thanks for taking my call. I've got a 457B plan through my employer. It's like one of those target date funds, basically. They make all the calls for me on that one. I'm not really any kind of control over what gets invested in. I've been putting into that one for quite some time, but was interested in picking up some other stock that would be of my own election, basically, and was interested in getting your guys' input on one that I found called PDAC. It's related to lithium-ion battery recycling.
Okay. Hey, and I got to ask you, Tony, about the target date fund. Are you forced to go in that fund, or did you pick it, or what?
No. I'm not forced to do it. I choose to, basically. I've been putting in money into it for probably about the past 15 years, probably, actually.
And what is the year, the target date?
I want to. It's like a 2040, Vanguard 2040.
Okay. And one thing I would suggest you do is look at the percentage of bonds versus equities, because we're not big on target date funds, to be honest with you, because we see that they have this set rule they have to follow. And why would you have any money in bonds as rates are going up? So say that, 30 or 40% of the money they have in bonds, I think the performance going forward is not going to be very good. And also, too, I don't know about Vanguard, but maybe these are what we call funds of funds, where they have a fund that owns other funds, and your fees, even with Vanguard. I mean, Vanguard has very low fees, but if they're doing a fund of fund, your fees can be higher than expected. So take a second look on that, because target date funds, I mostly it's on the bond side. I get worried about that. So, but let's take a look.
Gotcha.
What is this called? Peridot Acquisition Corporation?
Yes, that's it.
Okay. Symbol is PDAC. Unfortunately here, Tony, no PE ratio versus 2.6 for the industry. No price of sales. Price to book value 1.3. That's about the same as the industry. Well, better than the industry at 0.8. I'm not getting much on this company here. I have no sales growth, no earnings growth. The balance sheet, I say a current ratio of 3.8 versus 1.2. No debt on the balance sheet compared to 9,000 for the industry. I think it says in the lithium battery industry, so this is kind of like a new industry. I think this is a smaller company. Chase, do you have anything on this company at all?
Yeah, so actually, I look at the current price here to begin with. It's $10.24 for Peridot Acquisition Corporation. 52-week range, the low is $9.60, and the high, well, that's $15.74. The reason we're not getting much information on it is it actually is a SPAC. So it's a shell company, essentially. They are talking, it sounds like, about doing something in the lithium battery space. But the concern that we have with these types of companies, Tony, is they could be saying, oh, we're going to do this. And they could buy a terrible company, or they don't buy it. They merge with a terrible company that's in the lithium battery space. And all of a sudden, it's like, gosh, that's not the company I wanted them to buy. And now you're stuck with this new company here. So the scary thing about the SPAC market is it's truly gambling, because you have no idea what business that they'll end up merging with.
Right. And the SPACs are the special purpose acquisition companies, I think is what they stand for. And they're actually starting to come under a little bit of a scrutiny from the regulators.
Yeah. Because
they're kind of realizing, like, these are blind pools. They're kind of hyped a little bit. It's not where I would want to go with my money either. And I'd rather have you, if you're going to do the own investing compared to a target fund, do other companies. So unless, this is speculative because of the batteries for electric cars, but I don't like to speculate. And I think you said this is your retirement, or no, Tony?
Yeah, the one through the nationwide account, the target fund is for a retirement, correct? Retirement fund.
Yeah. And is this one from retirement as well that you're looking at using this for retirement, or no?
No. This was just something I'm into just as a long-term investment. I wasn't looking for anything to turn around anytime quick.
Okay.
Just something to possibly invest in for the future with the electric vehicle industry, kind of moving that direction. Thought it might be possibly be a good buy.
Yeah, it's very, very speculative. It is a gamble. It's something I would not recommend, because I like to see my money grow, not see my money go. So, yeah, I would recommend stay away from it.
Yeah, the tough part is it could go up, but it's also just could do nothing there, because it's don't know what the company is, and I like to invest in what we know, and there's not much to know about this company other than they have the idea of investing in a lithium battery company.
All right, Tony,
Gotcha.
and again, look more at that target date fund. Dig into that a little bit deeper. You might find that's not exactly what you want there. And if you have any questions, you call our office as well for you. All righty?
Thank you, guys.
Okay, Tony, have a good one. Bye-bye.
You too.
All right, that opens the phone line, 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Lane. Lane, you're in the Smart Vegetable Brand Chase. How can we help you?
Morning, gentlemen. This is Wayne in San Diego. It's okay. I have a general question. During last year, especially the summer when interest rates hit extremely low, historical lows, a lot of companies sold bonds to raise capital. Okay? My question is, a company like Apple, let's say they've got, $200 million in cash, but they sold $100 million worth of bonds. So they only have $100 million net cash on the books for just round numbers. And they took a bunch of this money to buy back stock. Wouldn't they be, why, if they have $200 million, why do you have to sell the bonds? I know you go out 10, 20, 30 years, these rates are going to be extremely low. But if you're generating so much cash for a company, why would you go out and put that debt on your balance sheet?
And I think we both have. And actually, Apple did something like this years ago, and they you remember this, Chase? They're going to go with, and they did it. It made sense, but I know what you're saying. Why would they do that? And you'd have to really look to see what type of interest rate they have. I don't like it, and I think it was maybe a wise move if you're kind of building the company, but I don't like it if they're using to buy back stock. And I think that's what you're kind of saying. Why did they do it? I don't know why they did it. Chase, do you have any?
Yeah, I mean,
guesses?
kind of to explain why they did it a few years ago is, the corporate tax rate was 35%, not to mention what the states charge as well. So they said, well, we're not going to repatriate that money. We're going to leave that money over in Europe.
Yep.
And then to raise capital, we're going to issue bonds, and then we'll buy back stock. Right. We have the cash, but it's kind of stuck overseas because we don't want to pay the high taxes. Well, now with the lower tax rate, I'm not quite sure why they would need to continue to issue debt.
Yeah,
and they're not the only major company that did it during the summertime.
Yeah,
and it might have just been for uncertainty. They didn't want to give up their maybe stock buyback plan, but they're like, "Gosh, we don't know what COVID's going to do. We can get a great interest rate." I'm going to almost say it's like we always tell people, open up a HELOC on your home if you own a home. You don't necessarily need to tap it. It's just good to have access to credit. I know a lot of companies opened credit lines just in case because they weren't sure how COVID was going to actually impact the overall economy. So it might have just been saying, well, hey, we can get a 1.5%, 2% interest rate. I don't know what it was. Let's take advantage of that just for that kind of sleep at night comfortability.
And before it did make a lot more sense because to repatriate the stock was going to cost a lot of taxes and so forth. So we can see that. Right now we're kind of guessing why they did this, and I can't find a good reason why they did, which does worry me.
They don't make major acquisitions. Probably $3 billion for the Beat earphones was the biggest acquisition that's ever been publicized, for Apple, for example.
Yeah.
It's not like Microsoft's going out and spending 10, 15, 20 billion dollars on deals, you know what I mean?
Right.
So,
and we can speculate they could change that. I know. I hope they don't do this. They sometimes talk about the Apple car and stuff. I think that'd be disastrous. I don't know why they did that. There was no reason to do it. You do have to pay that interest now going forward, and maybe it's only a 3 or 4% interest rate, but still you got to pay that.
And the dividend's minuscule. I mean, they could have raised the dividend to get the dividend at 2%.
Yeah,
and not sold bonds. You know what I mean?
Yeah, I agree with you 100%. I mean, that's why we don't own Apple. They're just the stock price is high, everybody loves it, but financially, there's things that just don't make sense to us.
Yeah, and there might have been something in the conference call. I think the CFO's name is like Luca something, I believe. But I know he used to address kind of why they would raise capital, what their plans were. So, I'm curious what he had to say about it when they did it.
Yeah. So, good questions. I wish we had the answers, Wayne, but good questions.
Because their goal, they say the long-term goal is to get net zero between assets and liabilities. And not even if you still got $100 billion sitting on at the bottom line, you got a long way to go.
Yeah. And I know too that their businesses could change because I know there's attack on the amount, the profits that they're making off of the App Store and stuff. What if that takes away their cash flow? So I don't know. I mean, it's a great business. They've done very well, but I just don't think it's worth 20. What's it? Forward earnings, 22 times forward earnings.
I don't know what the exact.
I can't remember. But
I was kind of surprised they did it, and there's a lot of other major companies that did the same thing. And I'm going, you guys got huge balance sheets of cash on that already. What do you need more for?
I know.
Unless you have a specific use for it. And Apple didn't come out and say have a specific use in my book.
Yeah, and I always go back 20 years. Like, what would Warren Buffett done? He wouldn't have done this at all. So, and I know he owns a lot of Apple, but Yeah, I agree with you. Another reason why I would not recommend owning Apple, because it makes no sense what they did. And same thing with other companies. We like to watch financially what they're doing. If they're doing something crazy, maybe we don't hold that company. All right,
Warren Buffett, I think, has his letter or his conference this week, and so it'll be interesting what he has to say about the market.
Yeah, I'm very curious how much of that letter he's writing now versus his lieutenants, as we call them.
Yeah, they're both getting up there in 8 years, so give them credit, whatever they do.
Yep. So,
thanks for your information, gentlemen. Appreciate the show.
Okay, Wayne. Thanks for calling. Have a good one. Bye-bye.
Bye.
All right, that opens on the phone line, 866-577-2473. That's 866-577-2473.
I'm just amazed right now. I just looked up the ages for Buffett and Munger.
Right.
Buffett is now 90.
Right.
And Charlie Munger is 97.
97. And he's still...
Oh, he was born on January 1st. January 1st, 1924. How about that?
He lived during the Great Depression.
Yeah.
I mean, they're not going to live forever. Somebody else, I think, just this past week died at 99. I mean, and I know there's more centenarians that are over 100 than ever before. But yeah, they're not going to live forever. And they're just like, Benjamin Graham. I mean, he passed away many, many years ago, but his principles live on. And I think the same thing will happen with Warren Buffett. His principles live on. And it's just common sense. And that's what people say. That's why our clients love what we do. It's like, it's so common sense. Why does everybody do it? Because the emotions come into play.
Yeah, and I will kind of, again, say what you said on that letter. I don't think it's the letter that it used to be. I mean, at 90, I do wonder how much Buffett is still involved. The Berkshire annual meeting, the shareholder meeting, I think they did like a conference call essentially last year, like an online presentation. I don't know. I don't think it has the same stigma that it used to.
No.
And I don't think it ever will.
Yep. But again, the principles will live forever.
Yeah.
And that's what you have to go back to, is not what he's doing now or what Berkshire Hathaway is doing now, but the principles will live on. Same thing that Benjamin Graham did as well. So, the workshop. I want to talk about the workshop again because this is May 1st, so it's only, 3 weeks away.
Yeah,
so
19 days.
19 days. So we do have limited seating there, but we will go over how we do investing, how we go over the fundamentals, how we get our target sell price, looking at how much you need to look into the financial statements, things you shouldn't be doing because it could be costing you money. It's all free, but what you have to do is you have to sign up. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Or call our office at 858-546-4306. That's 858-546-4306. Wait for Brianna's prompt. Talk to Brianna. She'll get you signed up. All righty. Let's go up to Buena Park and speak with Jeff. Jeff, you're on the Smart Invest Show, Brent Chase. How can we help you?
Hey, good morning, gents. Happy Saturday.
Yes, it is a happy Saturday. Beautiful out there.
Yeah. So I wanted to talk to you guys and get your thoughts on Xilinx. I've held it for a long time and got a proxy recently for AMD wants to buy Xilinx. And it looks like it makes a whole lot of sense to me. And so I voted for it, and I can't find my proxy anywhere, but it seems to me that in the proxy that they had fixed the share price at that AMD was going to pay for Xilinx at like 134 or something like that, and Xilinx has been relatively volatile recently, but I think last was like 127, 128, and I'm just wondering what happens, between now and then, if AMD is really going to pay that, and did I find that number, or was that a suggested number? Because I can't find it in any of the press releases now, and so just kind of curious, what do you do while you're sitting and waiting if you think you're going to get a 134 number at some point in time when they close the transaction, and you're at 127? So why should I wait for the locked-in locked-in gain? Or why shouldn't I buy more if I can get more down the road? You follow where I'm going?
Follow exactly where you're going. First question is, do you know if they're paying all cash deal, or is it cash and stock, or stock only? Do you know what they're doing on that?
I don't remember. I thought it was stock valued at the conversion rate of 134.
Okay, that makes a whole different situation, because if it was cash deal at 134, what would happen is that that's pretty much locked in. But now they're using AMD's using their stock as a currency. If their stock falls, well, that's not going to be good for Xilinx on this transaction. The other thing I tell people to look at when you look at Xilinx, would you keep this company if the deal doesn't go through? If the answer is no, then you sell it, you don't be part of it, and so forth. It takes it out completely. But that's why we'll go over the numbers for you. Chase, did you have something specifically on the deal?
Yeah, so it does actually look like the agreement reached last October. They agreed to acquire Xilinx. Under the terms, AMD will pay 1.7234 shares for each Xilinx share. So it's not the 134 in cash. I think essentially this is going to fluctuate. Xilinx will continue to fluctuate, not necessarily on Xilinx, but it could fluctuate off AMD's stock price, because that's what you'll be receiving.
Okay.
Yep. So let's take the numbers at Xilinx here to see if it's worth holding or not, because, again, you always want to be prepared. If the deal doesn't go through, the stock could drop dramatically because this pushed up the price, and then you're left like, oh, shoot, I should have sold a higher price. So I'm going to take a look at Xilinx here. Symbol is XLNX. PE ratio now 51.2, which is above the industry at 37.6. Price to sales 10.3, also expensive compared to the industry at 6.6. Price to book value 17.5 versus 23, and price to cash flow is 38.7 versus 20. Now you do get a 1.2% dividend. They use 59% of their earnings to pay that out. Sales for Xilinx are down 5.6% year over year, and I say wow because the industry's up 10%, and the earnings for Xilinx fell by 25.5% when the industry was down 0.6%. The balance sheet looks pretty good here. Current ratio 3.6 versus 2.3. Debt to equity 77 versus 64. And return on equity is 23.7, above the industry at 17.8. Net profit margin 20.3 versus 16.5. And then inventory turnover looking good as well. 11.7 versus 8.3. Inventory turnover 3, not as good as the industry at 4.8. Jace, what do you got for the earnings?
So current price here for Xilinx is $127.96. 52-week high is $154.93. 52-week low, well, that's $80.45. I go out to March 2022. I see estimated earnings per share of $3.31. Not surprised here. Would give us a target sell price of $53.29. So low because it appreciated so much after the news on the acquisition there. So as Brent said, I mean, if this deal were to fall apart, which it does appear it was approved by the shareholders of both sides, but if there's any regulatory potential problems, that could have a very negative impact on the stock price. On the upside, I do know I've seen this before, is people think, oh, there's going to be bidding wars and stuff. So when deals are announced, you could see it go above that acquisition price, but it looks like this one is pretty safe. So I think this is just going to continue to fluctuate based off of AMD's stock price.
Yeah. And I don't think you'll see much in profits either there, Jeff. So I would be saying I would take the cash, put it in the cash, look for something else to buy. There's not a lot out there to buy now, but I think over the next 6 months that will change. And then you'll be happy that you have that cash to turn around and buy something at a much better earnings. As Jason said, the deal could fall through, which doesn't appear to be that way. But if AMD has problems and their stock drops, Xilinx will drop as well, because you said 1.74.
It's like 1.7234.
Yeah. So I usually back away when a company's going to be acquired unless I'm still getting a good price, and I still like that company if the deal fell through. And this one it's fully valued.
Yeah. So Chase, where'd you find that? Because I've been looking for it because I couldn't find my proxy. Where did you?
I just canceled out of that. I believe it was on the street, and it was from April 7, 2021. But I just Googled like AMD XLNX,
okay,
and then
news.
Oh, yeah, and there's actually one on Yahoo. It's a Yahoo Finance one that AMD and Xilinx. No, that one didn't have the information. Sorry.
No, it didn't. Yeah, I looked there.
Yeah, it was thestreet.com. It says AMD acquisition of Xilinx approved by shareholders And that was on April 7th, 2021. So that's where I got those numbers.
And I think if you went to Xilinx's website as well, I'm sure it'd be there also, Jeff.
Yeah. So it does say that it's going to be a cash deal, huh?
No,
a stock deal.
I mean, a stock deal, but valued at, or they're going to give shares 1.723 per one.
Correct.
Right?
Yeah. So it values Xilinx at the initial price at around $143 per share, but it's all based off of stock. And they essentially converted that to the 1.7234 AMD shares.
Mm-hmm. Mm-hmm. Yep.
Well, the other thing too, Jeff, is that if you stay with it, then you're going to be holding AMD. Do you want to hold AMD? And if you say, "Oh no, it's way too pricey," then again, another reason to sell Xilinx now. So.
Yeah. Well, Xilinx. I mean, AMD's pretty pricey as well, but it's not as pricey as Xilinx. So it's kind of and of course, I mean, I think you guys were talking about AMD a little bit earlier. I mean, they have really become quite a powerhouse.
Yes, they've done very well.
And so I although they've run up a lot and become a lot more expensive than they were back like when I bought my Xilinx, it's I guess the thing I need to do is do some deep dive into there and into AMD and see how much I like that versus deciding whether I want to stay here. I just hate to. I have about a 45% gain in it right now.
Yeah.
And it's like I don't know if I want to pay the tax. And as you said, there's not a lot to buy out there right now, which makes it hard to want to sell.
Well, it actually doesn't, because if you're investing longer term, as I said, over the next 6 months, and when we sell something in our portfolio, it's not like, oh, we're going to buy something else. The two separate decisions.
Agree completely.
Yeah.
Agree completely.
So don't say, well, I don't want to sell it because I pay the tax and nothing to buy. Just say, no, I should sell this and move on. And, so. All right, Jeff?
Very good. I appreciate the help, guys. Enjoy the show.
Thank you very much. Have a good one. Bye-bye. All righty. That, I was going to say another phone, but it's like 5 till 10 already. Where'd the time go?
I don't know.
Yeah, one quick. So,
yeah. I think you might.
What's that?
Yeah, I'll let you take.
Well, no, because I was going to talk about the workshop, because this was a great one to kind of wrap up with Jeff, because we're talking about, well, I don't want to sell because of tax and so. This is what we talk about the workshop. I mean, if you enjoy the radio show and you enjoy the concept, this is why I don't think we've ever had anybody say at the workshop didn't learn anything, because we have different conversations. We go over what I've dealt with for, well over 25 years now, probably doing the workshops.
Yeah,
and it really gives you something to kind of grab onto when it comes to investing. We talk about target prices. We talk about the financial statements. We talk about what not to do. We talked earlier in the show with somebody that had a target fund. We talk about why not to do mutual funds or target funds. I mean, how you can not make money on those. I mean, this is why we do the workshop, and it's free. We love doing it in person with people. It is going to be Thursday, May 20th at 6 o'clock at the AleSmith Brewery right off of Miramar Road. And it's a great time. I'm so happy that we get back to do these in person again, because I've done them for over 20 years now, and it's such a pleasure to get out there, because I love doing the radio show, but I also like being in person with people and the conversations that we have and what we do in the workshop.
Yeah, and I think the reason people enjoy it, and it's interesting, I had a conversation with a gentleman yesterday. He's not a client. He likes to do it himself, but he's like, you guys are my number one pick when I decide I want to not do it anymore, essentially. He said, the reason is I think there's so many other salesy people out there that just sell products and things like that. He said, I don't get that from you guys. And it's true. Don't get us wrong. We want to manage money. That's what we do. That's our service is an investing service.
Right.
But, if you don't want to invest with us, that's okay. Yeah. We're not going to be mean to you after the workshop or anything. We're not having you come to the workshop just to sell you a mutual fund or sell you some annuity or anything like that.
Right.
We show you what we do, and if you like it, great, become a client. If you want to take it home and do it yourself, okay, that's cool too.
Yeah. And that's exactly it, because we want to show you what we do, because we also know nobody else does what we do, and it can't really be duplicated, because I've been doing this for so many years. Somebody can try to duplicate it, but they want to have the same thing. But that's why we show you everything, how we do it. We would love to have you as a client. if you want to be. If not, we enjoy our listeners as well. We enjoy speaking and helping other people out as well. So if you want to sign up for the workshop, it is free. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Click on the tab for the workshop. Get signed up. We'd love to see you there on Thursday at 6 o'clock, May 20th at AleSmith Brewery. You can call the office at 858-546-4306. That's 858-546-4306. And just wait for Brianna's prompt to come up and sign up with her there. But really looking forward to this. I'd love doing the workshops.
Yeah, and we look forward to doing them this year and look forward to the economy continuing to reopen, and it's going to be a good year.
Yep. And there's closing bell, so thank you for listening to the Smart Investing Show. It is for information purposes only. It should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information on investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Today's show is sponsored in part by Thomson Reuters Refinitiv. Closing song, Frank Sinatra's My Way, is performed by local entertainer Roman Palacios. Have a great day. Thanks for listening to the Smart Investing Show. We'll talk more next week.
And may I say, not in a shop.